Hey, welcome back, everyone. Wanted to talk very quickly about some of the events in the markets. Last week was just terrible. The end of the week, the weekend couldn't come fast enough for people on Wall Street, people investing, people who are still hoping to find some value in their 401ks and retirement plans. Just a couple points. The Dow Jones Industrial Average dropped by 3.5%. The S&P was down 4.6%. The Nasdaq Composite down 4.8%. All of that happened within just 5 trading days, from Monday through Friday of last week, just a few days ago. So the performance adds a real insult to the injury in what has been a disastrous year for investors. The Dow was down 19%, the S&P down 23%, and the Nasdaq is down nearly a third from their respective all-time highs around the end of the year. So a lot of people are asking, is there a silver lining to all this? Have we found a bottom yet? Are the markets attractive at these levels? I'd say for those tempted by these questions right now, here are just a few things to consider in this moment, in this environment. So we've had several notable news events over the past couple of weeks that coincided with the decline. First, higher than expected inflation print. CPI was up 8.3% for August, which kind of confirmed to the markets what everyone already knew. I mean, anyone who's filling up their own gas tank or shopping for their own groceries knows that for the things that really matter, inflation isn't getting any better, it's getting worse, especially for what people care about, which is housing, energy, and food. And these issues, these factors, these categories are going to continue to pressure consumer sentiment in the coming months. The second, the U.S. Federal Reserve, our central bank, announced another 75 basis point rate hike. We're three-quarters of a percentage point. And this was the 5th increase of the year, and it's brought the Fed's fund rate, the target rate, of up to 3 to 3.25%, which is up 300 basis points, or 3%, from just a year ago. And this is the first time that target rate has been above 3% since before the global financial crisis. So quite a change. It's made everything from mortgages to auto loans to everything else a lot more expensive. And it's really cold water in the face of the institutional investors, especially those that have leverage on their investments. And I think this is one of the reasons why you saw such a dramatic shift last week. There are other signs that the health of the economy is deteriorating. You're hearing a lot of talk about recession right now. Just one example is that an index called the Leading Economic Indicators, one of the most well looked at things to just measure overall health in the economy, fell by an additional 0.3% for August. That was following a total of 2.7% decline over the past 6 months. At the same time, the Fed sharply lowered its forecast for growth here in the U.S. for 2022, reducing those forecasts from 2.7% growth back in June to a very weak, very anemic 0.2% just last week in September. So these things have really caught people's attention and are creating some concern. Unemployment also ticked up a bit, although labor markets remain very tight for right now. So we'll see how that plays out over time. But I think the important point is that the weight of negative economic news that we're seeing is likely to grow, not diminish going into the fourth quarter, and that's a warning. One other thing that's really, I think, worthwhile to note: it's true that the valuations of stocks and assets have come well down from their peaks. So if you look at the stock market, the equity values, they do remain very high, though, despite the fact that they're down significantly. And one big measure of this, common measure, is the price to earnings ratio. So how much you have to pay for a given stream of earnings from a company or stock that you're investing in. Now, this ratio has fallen by 25% over the last year, or since the beginning of the year, from roughly 37 times earnings to 28 times today. That sounds like, okay, maybe things are getting better, more attractive, but it's important to keep in mind that the historical median for that ratio, for what's called the Shiller PE ratio, is 16 times earnings. So on that basis, we're still very high, very expensive. There's still a lot of air in the balloon, especially in a rising rate interest rate and a recessionary environment. And if we look forward at earnings, that number would imply even more expensive stocks, because earnings are likely to fall, are going to be compressed going into next year. So stocks still look very expensive. And rising inflation oftentimes can be a positive factor for equity values, but right now these recessionary forces are exerting the stronger influence between the two. And one way to look at this is the earnings yield on the S&P 500 is just above 5% compared with its historical norm or median, at least, of 6.7%. And when you compare that against 8.5% inflation, which we've seen for at least the last 6 months since March, basically this is implying that the equity market is trailing inflation by around 40%. So even if your cash is much worse, but even if you're in stocks, you're still not keeping up with this rate of inflation, if those numbers can be believed. So for me, in this environment, nothing feels safe. I mean, the only thing that gives any comfort at all are higher yielding energy companies, oil companies, other commodities, where they should continue to perform even in this very difficult environment, especially as you look at Europe's energy crisis going into the winter and that continuing. And also, some of the global miners, people that provide the basic minerals like coal and other things, strategic metals that really have completely fallen out of favor with the ESG crowd of large institutional investors. These companies, miners, trade at single-digit price earnings and double-digit cash dividends. So actually pretty attractive. But other than that, it's really hard to get excited about much else being able to resist the tide. And I think it's a moment to be cautious and to be prudent. Now, interestingly, we start this week with Rosh Hashanah, the Jewish New Year, welcoming in the year 5783 according to the Jewish civic calendar. So symbolically, we can hope that this new year brings with it a turn in the markets, because a lot of Americans, a lot of people, not just institutions, but ordinary people with retirement funds and other things, have a lot riding on how this works out. And so with that new year, we can hope for a turn in the markets. However, I would caution that trying to time the market is really a fool's errand, and that's true in the best of clear blue sky types of environments, which this is not. And we're in a very difficult season that is stormy. And just as we're watching the Hurricane Ian approaching the coast of Florida, I think we're also in a very stormy and dangerous weather situation in our economy. And we see that because we see how fundamentals are still deteriorating. And of course, geopolitics have entered into a very dangerous new phase, with reason to believe that the risk of surprise news, whether it be out of Russia or China, may be to the downside. So while we'd all like to see this parade of horribles come to an end, it doesn't feel like the bottom is in yet. But so that was just a quick note, quick update. Hope you enjoyed it. If so, please like it, share it, and subscribe here on the YouTube channel. Turn on the notifications bell. A couple other things. If you haven't done so already, go to stormwell.com, sign up with your email for notifications, publishing everything from published articles to blogs, videos, a lot of other stuff. It's great to have you there and paying attention to that. And also my new book, Why America Matters, is coming out in about another month, towards the end of October. You can go to whyamericamatters.com, whyamericamatters.com, and pre-order. And it's going to be great. Very excited. I think I have a lot of interesting things, important things to say to America and about America at this time in our history. So thanks for joining, and we'll see you next time here on stormwell.com.